Well, there's been a lot of talk lately about the failed talks in Islamabad, the new US blockade move, and whether this whole thing is about to send gold and silver flying or crashing. So, in this video, we're going to separate fact from fiction, and you're going to walk away with a much clearer picture of what actually happened, what was exaggerated, and what may matter most for your money. And by the way, in New York, it is Monday, April 13th. Let me know in the comments what day and date you're watching from. Also, quick note before we get into it. We do have members-only videos made by a separate team that goes even deeper with the research, and those are reserved for premium members. If you value this kind of coverage, support the channel by subscribing, because right now, a lot of people are looking at one headline, filling in the blanks with fear, and jumping straight to the conclusion that this automatically means precious metals have to explode higher. And on the surface, I get it. Failed peace talks, a blockade announcement, a major oil choke point. It sounds like the kind of thing that should send everybody rushing into gold and silver with both hands. Except that is not what the market did right away. Based on the latest confirmed reporting, the weekend negotiations between the United States and Iran in Islamabad ended without a deal, and the U.S. then announced that a blockade would begin on Monday morning, New York time. But here's the first big correction that matters. The operational order is aimed at ships going into or coming out of Iranian ports. It is not a blanket stop on every ship simply passing through the Strait of Hormuz to non-Iranian destinations. That distinction is huge, and a lot of the louder commentary online is blurring it. And that one detail changes how you should think about the whole story. Because if you hear, the strait is blocked, all traffic is shut, world trade is frozen, your mind immediately goes to total chaos. But if the actual order is narrower, and it is, then you're not looking at the exact same kind of shock. You're still looking at a serious escalation. You're still looking at a major supply threat, but you are not looking at the most extreme version of the story that some people are selling. Now, does that mean this is no big deal? No, not even close. The Strait of Hormuz is still one of the most sensitive places on the energy map. Based on the latest official energy update, a little over 20 million barrels a day moved through that channel in the first half of last year, which works out to about 1/5 of global petroleum liquids consumption. It also carried more than 1/5 of global liquefied natural gas trade. So even when the blockade order is narrower than the headlines make it sound, the location itself is still powerful enough to move oil, currencies, shipping, inflation expectations, and yes, precious metals. And here's another part that gets missed. The United States is not as directly exposed to Hormuz as many Asian buyers are. That same official update says U.S. crude and condensate imports moving through Hormuz were only a small slice of U.S. consumption, while Asian markets took the overwhelming share of those flows. So when this route gets squeezed, the pressure is not spread evenly. China, India, Japan, and South Korea feel it harder. That matters because the global reaction is not just about what the U.S. does next. It is also about how Asia absorbs higher energy costs, slower growth, and imported inflation. So let's back up for a second and look at what actually broke these talks. Recently published reporting shows the meeting in Islamabad was the highest level U.S.-Iran engagement since the revolution era, and it came after a fragile ceasefire had already been announced days earlier. Iran came in pushing for relief on sanctions and blocked assets, compensation for war damage, a broader ceasefire that included Lebanon, and a stronger position around Hormuz. The U.S. side wanted sweeping nuclear restrictions, wider regional concessions, and freer maritime access without tolls or Iranian control. Those are not small gaps, those are structural gaps. So when people say, I knew these talks were going nowhere, they're not pulling that out of thin air. The disagreements were deep before anyone sat down. Iran's delegation was reported at around 70 people, led by senior political figures, and the public tone even before the talk started was basically, we're willing to talk, but trust is missing. On the other side, Washington was pushing hard on uranium enrichment, missile concerns, and regional armed groups. In plain English, both sides showed up with a list of things they considered core interests, and the overlap just was not big enough. And that is why I want to challenge one easy narrative right away. Some commentary makes it sound like this was a simple situation where one side had all the leverage, the other side had none, and the failure was just a formality. I don't think that is a serious way to read it. A weaker military position does not erase leverage when you sit on a shipping choke point that carries a giant share of the world's energy trade. That is exactly why Hormuz keeps showing up in the center of this story. Even a damaged state can still create expensive problems if it can squeeze a narrow passage the world depends on. That does not make every Iranian demand realistic. It does not make every U.S. demand realistic either. It just means leverage in this kind of crisis is not only about tanks and aircraft. It is also about geography, timing, and the cost you can impose on everybody else. And once the talks failed, the market reacted fast. From early market updates, Brent moved back above $100 a barrel, the dollar strengthened, and both gold and silver slipped instead of rallying. Spot gold was trading around $4,730 an ounce, and silver was down near the mid-70s. That is the opposite of what a lot of casual viewers expect when they hear Middle East escalation. But it is exactly what happened in the opening response. So why would gold and silver fall when the news sounds this dangerous? This is where a lot of people oversimplify the safe haven story. Fear does not always go into the same door first. Sometimes the first move is not into metals. Sometimes the first move is into the dollar. Sometimes it is into short-dated cash. Sometimes it is simply out of risk. And in this case, the stronger dollar mattered a lot. Gold is priced in dollars, so when the dollar jumps, bullion gets more expensive for buyers using other currencies. Add higher oil to that, layer in inflation worries, and suddenly the market starts thinking central banks may stay tighter for longer. That is not friendly to non-yielding metals in the very short run. That is the key point. It was not just war fear pushing buttons. It was war fear translated through oil, then through inflation, then through rate expectations, then through the dollar. And once you understand that chain, the move in gold and silver stops looking strange. In fact, recent reporting shows traders now see very little chance of rate cuts this year because higher energy prices are feeding inflation concerns again. That is a big deal. Gold can handle geopolitical stress. Gold can also handle inflation stress over time. But gold does not love the idea that rates may stay high while the dollar stays firm. Silver gets it from both sides, because it is monetary, yes, but it is also tied to industrial demand and broader risk appetite. And silver especially can be messy in moments like this. People talk about silver like it always behaves as a miniature version of gold. It doesn't. Sometimes it acts like money, sometimes it acts like a growth-sensitive industrial metal. Sometimes it just gets pushed around harder because it is a smaller market and traders are less patient with it when volatility jumps. So when somebody tells you, this news guarantees silver moonshot now, that is not analysis, that is wishful thinking. Could that change later? Yes. And that is where the story gets more interesting, because the same event that hurts metals in the first reaction can help them in the next phase if the energy shock lasts long enough. If oil stays high, if supply stays tight, if inflation stays sticky, if shipping insurance stays expensive, if central banks start looking trapped between slower growth and higher prices, then you have a very different backdrop. That is when people stop saying, I need dollars right now, and start asking, how long can this system absorb higher energy without breaking something? That later question is where gold and silver can start to get stronger again. So the first move and the lasting move do not always point the same way, and that is one of the biggest mistakes I see retail traders make. They treat the opening reaction like the final verdict. It almost never is. Let me show you why the oil side of this matters so much. Based on the latest official short-term outlook, shut-ins tied to Hormuz disruption averaged roughly 7.5 million barrels a day in March, and the agency expects that figure to rise to a little over 9 million barrels a day in April, before gradually easing later. That is not some tiny side issue. That is a major supply hit. The same report says these disruptions imply a large global inventory draw this year. So when the market hears new blockade, it is not reacting in a vacuum. It is reacting on top of an energy system that was already strained. And there's more. Recent market reporting shows that Iran had been exporting around the high 1 million barrel a day range in March and the first part of April. If the blockade effectively chokes those barrels off, that removes a meaningful stream of crude from the market. At the same time, there is already a backlog sitting in the system, with more than 180 million barrels of Iranian crude afloat and well over 100 tankers inside the Gulf. So this is not just about what is moving today, it is about what cannot move tomorrow. Now think about what that does psychologically. Every refiner, every importer, every shipper, every trader starts asking the same question. Even if the blockade is narrower than advertised, how long does this last? Who enforces it? And what happens if somebody challenges it? And that brings us to another big point that gets lost in the noise. A blockade sounds decisive. It sounds clean. It sounds like one side flips a switch and the other side folds. Real life usually doesn't work like that. Recent expert analysis describes this as a major, open-ended military undertaking that could be difficult for one country to sustain over time. That should make you pause. Because if the market decides this is not a quick pressure tactic, but the beginning of a longer, more unstable standoff, then the oil premium can stick around longer than many people expect. And if the oil premium sticks, the inflation pressure sticks too. So the market is trying to price two things at once. First, the immediate hit. Tighter oil, stronger dollar, weaker metals. Second, the follow-through risk. Drawn-out disruption, retaliation, policy stress, and slower global growth. And those two phases can pull assets in different directions over different time windows. That is why anybody giving you a one-line answer here is probably leaving out half the picture. Now, what about the claims that this is already a giant coalition move and everybody is lining up behind it? That is not supported by the most reliable reporting I looked at. In fact, Britain publicly said it would not support the blockade and did not want to be dragged into war. That matters because it tells you the Allied picture is not as uniform as some commentary suggests. When a move this serious does not automatically bring in broad public backing from close partners, you should be careful about assuming there is some giant unified front already locked in place. That does not mean the US cannot do it. It means enforcement, legitimacy, burden sharing, and duration all become bigger questions. And those questions matter for markets because uncertainty that drags out is often worse than uncertainty that resolves quickly. Traders can price a clean outcome. They hate a moving target. There is also another exaggeration I want to strip out. You've probably seen claims floating around that this update proves total military collapse on one side, or that nearly everybody at the top is gone, or that there is basically no capacity left for a response. That is not a careful reading of the available record. Yes, there has been major damage. Yes, top leadership losses have happened. Yes, military assets have been hit hard. But intelligence reporting and expert commentary have also said the regime remains intact, though degraded, and that Iran still presents a long-term problem with leverage, retaliation options, and buried highly enriched uranium. That is a much more grounded picture than the chest-thumping version. And why does that matter for gold and silver? Because markets do not price slogans. They price what can still happen next. If a government is bruised but still able to threaten shipping, mine waterways, hit infrastructure, or force a prolonged naval commitment, then the risk premium stays alive. If, on the other hand, one side had no ability left to complicate the picture, then the market could treat this as a short operation with a cleaner ending. Those are two very different setups. This is also why the ceasefire angle matters more than people think. The talks happened only days after a ceasefire was announced, and even before this latest failure, the truce looked shaky because of disputes over whether Lebanon was covered and because both sides were still far apart on core terms. So when the weekend produced no agreement, the danger was not just bad diplomacy. The danger was that the thin layer of stability on top could crack again. Trusted reporting is careful here. It supports saying the ceasefire is fragile. It does not support declaring that a full restart of war is already a done deal at this exact moment. That caution matters. Because if you jump from talks failed straight to therefore total war is immediately back, you can end up reading the next market move completely wrong. Markets price probabilities. They do not wait for certainty, but they also do not always price the loudest scenario as the base case. And there's one more wrinkle. Trump's messaging has not been perfectly linear. Recent reporting noted that after the talks failed, he still suggested more negotiations could happen, even while the blockade order was moving ahead. That kind of mixed signal matters because it leaves room for another diplomatic swerve, another back channel, another pause, another partial concession, or at least another headline that forces traders to reprice the entire setup again. In other words, this is not a closed script, it is still being written. So if you are trying to trade gold and silver off this story, you have to separate what has already happened from what people are projecting. What has already happened is clear enough. The talks failed. The blockade order was issued. The official scope is narrower than all ships everywhere. Oil moved up sharply. The dollar strengthened. Gold and silver fell in the opening reaction. Britain said no to joining the blockade. Iran warned that approaching military vessels would be treated as a ceasefire breach. Those are the hard facts that matter most right now. What is not clear yet is how long this lasts, how strict the enforcement becomes, how many ships tested, whether talks quietly restart, whether the ceasefire fully unravels, and whether energy inflation begins to spread into broader consumer expectations again. That second list is where the next big move in metals will come from. Now let's talk about the biggest misunderstanding I'm seeing in the gold community specifically. A lot of people hear oil above 100 and assume that must be pure rocket fuel for gold right now. Not necessarily. Over time, maybe. Immediately, not always. If higher oil makes bond markets think inflation will stay hotter for longer, and if that keeps yields elevated while the dollar stays firm, gold can stall or even fall first. We literally just saw a version of that. And recent reporting noted gold has already been under pressure for weeks because the energy shock since late February has kept inflation worries alive and pushed rate cut hopes further out. That is why simplistic fear equals gold up thinking can get expensive. Gold is not only a fear asset, it is also highly sensitive to real rates, the dollar, and policy expectations. It can benefit from crisis, but it does not benefit from every crisis in the same timing sequence. Silver is even trickier. If the market starts worrying that high energy costs will hit manufacturing, shipping, and global demand, silver can get smacked harder at first because the market sees both slower growth and tighter financial conditions. Later, if policy credibility slips and inflation sticks, silver can snap back hard. But again, the order matters. Timing matters. You do not get paid for being vaguely right 6 months early if you get steamrolled in the opening move. So where does that leave us? In my opinion, this is a short-term headwind for gold and silver. Not because the geopolitical story is small, but because the transmission mechanism right now is dollar strength and rate pressure. That is the immediate layer. The next layer, though, could turn much more supportive for metals if the energy shock stays in place, if inflation keeps biting, or if confidence in policymakers starts fading. That means there are really two different theses here. The fast thesis is defensive cash, firm dollar, metals under pressure. The slower thesis is persistent oil stress, sticky inflation, weaker growth, policy confusion, and eventually renewed demand for hard assets. You do not have to choose which one is morally satisfying. You just have to recognize that both can happen in sequence. And from a practical point of view, the thing I would watch closest is not social media noise. It is the interaction between oil, the dollar, and rate expectations. If oil stays elevated, but the dollar starts rolling over, that changes the picture. If oil stays elevated and recession fears start overwhelming the higher for longer rate story, that changes the picture too. If diplomacy restarts and the energy premium comes out fast, then some of this pressure on metals can reverse for a completely different reason. So there is no single trigger. There is a chain. Another fresh piece of context here is that the energy system does have bypass capacity, but not enough to fully replace Hormuz. The latest official work says Saudi Arabia and the UAE together can route a meaningful amount of crude outside the strait through pipelines, but only a portion of what normally flows through. Iran's own bypass route on the Gulf of Oman remains small by comparison. So yes, alternatives exist. No, they do not solve the problem. That is why every disruption around Hormuz keeps carrying an outsized price effect. And that is also why this is bigger than one day of market action. Once traders start seeing a choke point as structurally unstable rather than temporarily stressed, they build a premium into everything touching it. Crude, refined products, shipping, insurance, freight, even food and manufacturing chains later on. That can bleed into ordinary life very fast. Recent energy reporting says U.S. fuel prices could remain elevated for months, even after normal flows begin to return, because reopening a route like this is not like flicking a light switch. The physical system has to unclog, inventories have to move, and risk premiums do not disappear the minute a press release sounds calmer. So even if diplomacy somehow improves from here, there can still be an aftershock in prices. That matters for metals because public inflation pain changes investor behavior. When people start feeling energy and transportation, groceries, deliveries, and household budgets, inflation stops being an abstract chart and becomes a daily irritation. That is when trust in temporary explanations weakens. That is when hard assets can re-enter the conversation in a bigger way. So I would be very careful about treating this morning's move in gold and silver as the final word. It may just be the first chapter. And yes, there's a trading lesson hiding in all of this. A lot of viewers want one clean answer. Buy now, sell now, panic now, celebrate now. But the market almost never rewards that kind of emotional speed. The better question is, what stage of the process are we in? Are we in the shock stage, the repricing stage, the retaliation stage, or the policy stage? Because gold and silver can behave very differently in each one. Right now, I think we are still in the shock stage. The market is sorting the basic facts, repricing oil, repricing the dollar, and adjusting rate expectations. If this spills into a longer confrontation, then we move into a different stage, and that is where metals could start telling a different story. Also, pay attention to what does not happen. If the blockade starts but commercial traffic to non-Iranian ports still moves, if the backlog slowly clears, if back-channel talks resume, if allies avoid deeper involvement, and if the market concludes this is pressure theater more than permanent rupture, then the panic premium can cool faster than people think. On the other hand, if enforcement broadens, if more countries' shipping gets tangled up, if there is a direct clash at sea, or if the ceasefire fully snaps, then the whole conversation changes again. That is why I do not like absolute takes here. And frankly, absolute takes are part of what made some of the early commentary so misleading. You do not need to tell people the most dramatic version of events to explain why this matters. The verified version already matters plenty. Failed talks at the highest level in decades. A new U.S. blockade directed at Iranian ports. Iran threatening retaliation. Oil above 100. The dollar stronger. Gold and silver weaker in the opening move. One of Washington's closest allies declining to join. That is already a serious story. You do not need extra fireworks glued on top of it. And let me add one thought for long-term metals holders. If your whole thesis depends on every geopolitical scare producing an instant vertical move in your favorite metal, that is not a strong thesis. A strong thesis can survive messy timing. A strong thesis can survive a stronger dollar for a while. A strong thesis can survive a market that chooses cash first and metals later. If you believe in gold and silver, your conviction should be built on a wider view than one overnight headline. At the same time, if you are a short-term trader, do not marry the long-term story so hard that you ignore the tape right in front of you. The tape just told you that, for now, the market cares more about the dollar and inflation pressure than it does about the classic panic bid into metals. That message could change, but that is the message for now. So here's the cleanest way I can put it. The core event is real. The broad, all ships are blocked framing is not quite right. The oil move is real. The stronger dollar is real. The drop in gold and silver is real. The idea that this automatically settles the long-term direction of metals is not real. That last part still depends on what happens next. Do back-channel talks restart? Does the blockade stay narrow, or does it widen in practice? Do more tankers turn away? Does the Fed-facing inflation story get worse? Does the dollar keep climbing, or does it fade once the first fear rush is over? And here's a question for you. Do you think the market is overreacting to the blockade headline, or underreacting to the longer-term inflation risk? Let me know below. And one more thing. If you're successful, share your success story in the comments so others can stay motivated. For me, the smartest stance right now is to stay flexible, stay factual, and refuse to let exaggerated narratives make decisions for you. There is enough genuine risk in the confirmed story. We do not need to borrow drama from rumors. So my working view is this. Short term, this looks like pressure on gold and silver because oil up plus dollar up plus fewer expected rate cuts is a tough mix. Medium term, if the energy shock hangs around and trust in policy weakens, that same crisis can start building a much more constructive backdrop for metals. That is not a contradiction. That is just how markets often work. They hit the obvious trade first, then they discover the deeper one later. And that is why I would not be shocked at all if the people cheering a metals breakout today end up being early, while the people dumping metals forever off one ugly session end up being wrong for a different reason. This story still has room to turn, a lot of room. So watch oil, watch the dollar, watch rate expectations, watch whether the blockade stays limited to Iranian port traffic, watch whether diplomacy goes totally dark or quietly restarts. Those are the signals that matter more than the loudest clips and the boldest thumbnails. And of course, subscribe if you want more of these sharp, simple updates without the noise. We'll keep tracking it. We'll keep separating the confirmed facts from the oversized claims. We'll keep looking at what it means for gold and silver, not just what sounds exciting for 5 minutes. Because that is how you stay ahead of stories like this. Not by guessing the loudest outcome, by understanding the chain reaction before most people do. Before I wrap this up, there are 3 more fresh context points worth knowing. First, right before this latest move, shipping data showed a few supertankers had started making it through the strait again after the ceasefire, which tells you the system had not completely normalized, but it also had not become a permanent dead zone. Then the talks failed, the blockade order came in, and traffic uncertainty spiked again. That sequence matters because it shows how fragile confidence is. This is not a normal market. It is a market that keeps reopening a crack, then slamming it shut again with the next headline. Second, the latest energy outlook cut expected global demand growth sharply, largely because Asia is more dependent on Middle East crude, and because shortages and conservation efforts are already changing behavior. That is a sneaky but important part of the story. High oil is not just a price story, it becomes a demand destruction story too. And when that starts happening, silver traders in particular get nervous because they see industrial sensitivity before they see monetary upside. Third, even if you were focused only on the United States, you cannot shrug this off and say, well, America barely imports through Hormuz, so who cares? That is too narrow. The US can be less directly exposed on barrels and still feel the price through the global benchmark, through diesel, through shipping, through airline costs, through manufacturing inputs, and through the inflation psychology that comes with all of it. That is exactly why this kind of overseas disruption still lands at the gas pump and still changes rate expectations at home. And here is one more skeptical angle I think deserves attention. Some people are treating the blockade announcement like a final answer, almost like diplomacy is over and the military track is now the only track. I'm not convinced. When leaders keep sending mixed signals, when official enforcement language is narrower than the broad political language, and when the economic cost of a long naval squeeze is obvious, there is still room for bargaining, back-channel pressure, and face-saving adjustments. That does not mean peace is close. It means hard escalation and renewed negotiation can both remain on the table at the same time. That is uncomfortable for traders, but it is real. And it is another reason why chasing the first emotional move can be dangerous. One more question for the comments. Do you think gold and silver are setting up for a short-term flush and then a rebound? Or do you think the stronger dollar trade keeps control longer than people expect? Either way, details matter more than the slogans. One practical signal I'd watch over the next day or two is tanker behavior, not just political language. If more vessels start turning around, anchoring, or delaying entry while mariners wait for formal guidance, that tells you the market is treating this as more than theater. If traffic keeps moving to non-Iranian ports with only limited disruption, that points to a narrower shock. Shipping behavior will tell us a lot faster than speeches will in the real world. And as always, take this as market education, not a personal buy or sell instruction. I'm giving you my read on the facts and the setup, but your money, your timing, and your risk are yours alone.